a 72% profit crash for one of Singapore's biggest banks. When a headline like this drops, the immediate question is this just the beginning? Is this the first domino to fall in the Singapore banking sector? Today, we're doing an institutional-grade deep dive into United Overseas Banks, or UOB's, shocking third-quarter earnings report for 2025. But we're going to do something different. We're going to look past the scary headline to understand what's really going on. Is UOB in trouble? What does this mean for its rivals, DBS and OCBC? And most importantly, what does it mean for your money? Stick around, because the real story is far more interesting and crucial for investors to understand. Quick disclaimer before we jump in. This video is for informational and educational purposes only and should not be considered financial advice. All investment decisions should be made with the help of a qualified professional. All right, let's tackle that headline number first. UOB's net profit fell a staggering 72% year-on-year, down to SGD 443 million. The market was expecting 1.3 billion, so this was a huge miss. But here's the secret. This wasn't because the bank's core business collapsed. In fact, UOB's operating profit, before they set aside any money for risks, was only down 16%. So, what happened? UOB's management made a strategic, preemptive move. They set aside a massive SGD 615 million in general allowances. Think of it like this. Imagine you run a successful cafe. Your sales are strong, but you decide to put a huge chunk of your cash into a savings account this month just in case coffee bean prices spike next year. Your personal take-home profit for the month would look terrible, but your business itself is still healthy and prepared for the future. That's what UOB did. They're strengthening their balance sheet for potentially tougher economic times ahead. And to prove their confidence, they explicitly said they will protect the final dividend for 2025. This isn't a panic move, it's a power move. So if the 72% drop was a strategic choice, what's the real problem? It's a term you need to know: net interest margin, or NIM. Simply put, NIM is the difference between the interest a bank earns from loans and the interest it pays out on deposits. It's the bank's core profit engine, and right now, for all Singapore banks, that engine is sputtering. As global interest rates have peaked and started to decline, the rates banks can charge on new loans are falling faster than the rates they have to pay on existing fixed deposits. That spread, their margin, is getting squeezed. UOB's NIM compressed by 23 basis points to 1.82%. That's a significant hit. But here's where the story gets fascinating. Let's bring in their biggest rival, DBS. DBS faced the same economic headwinds, but their NIM only compressed by 15 basis points. Their profit was down only 2%. Let's look at the numbers. For Q3 net profit, UOB was down 72%. DBS was down only 2%. For net interest margin, UOB was at 1.82%, a drop of 23 basis points. DBS was at 1.96%, a drop of only 15 basis points. And for fee income, UOB was down 2%, while DBS saw growth of 22%. Why the big difference? Two words: superior execution. DBS has been more aggressive with its financial hedging strategies and more effective at managing its deposit costs. This tells us the game has changed. It's no longer just about the overall economy. It's about which bank's management team can navigate this challenging environment best. The Singapore banking sector is bifurcating, splitting into clear winners and laggards. So how does UOB plan to fight back against this margin pressure? Their 2026 guidance gives us the answer. They expect loan growth to slow down and NIM to remain under pressure. The key to their strategy is a huge push in fee income. This is money they make from things like wealth management, credit cards, and investment banking, services that don't depend on interest rates. But this brings us to the single biggest question for UOB's future. Can they actually achieve this ambitious 8 to 20% growth in fee income? It's a tough challenge, especially when the current leader, DBS, just posted a massive 22% growth in commercial book fee income. DBS is already capturing a huge share of the market. UOB's ambition to match this is yet to be proven. So, let's bring this all together. What does this mean for you as an investor? Based on this analysis, the Singapore banks can be broken down into 3 categories. 1. The winner, DBS. DBS is the clear outperformer. Their execution is top-notch, allowing them to protect profits even in a tough cycle. This is why their stock trades at a premium, around 2.3 times its book value. The analysis suggests a buy or overweight rating for investors who want both income and growth. 2. The performer in the middle, UOB. UOB's core business is resilient, and its massive provision shows prudence. The dividend, with a yield of around 4.4%, seems safe for now, making it a decent option for income investors. However, with significant challenges in margin and fee growth, its stock growth potential is limited. The analysis sees it as a hold for income, but a reduce for growth investors. 3. The laggard or risk, OCBC. OCBC is positioned somewhere between UOB and DBS. While their wealth management is strong, they face similar, if not greater, margin compression vulnerabilities. They represent a higher execution risk. The bottom line is this: the sector has shifted from a growth story to an income story for the time being. So, let's go back to our original question. Is UOB's 72% profit drop just the beginning? The answer is partially yes, but with a huge nuance. The catastrophic headline declines, like 72%, are not the new normal. That was a one-off strategic provision. However, the pressure on earnings from shrinking interest margins, that is absolutely just the beginning. This will be a prolonged challenge through 2026. This isn't a quick dip, it's a prolonged grind. Here are the 3 key takeaways for every investor watching. First, headline earnings are not business quality. That 72% drop masked a resilient core business. Always look deeper than the headline. Second, execution is everything. Superior management, like we're seeing from DBS, is what separates the winners from the losers in a tough market. And third, the sector is now hold for income, not for growth. With profits likely to be flat or grow only slightly in the 0 to 3% range for the next year, the big gains are probably on pause. The attractive dividend yields are the main reason to hold these stocks right now. The profit drop wasn't a catastrophe, but it was a clear signal of the multi-year earnings challenges ahead for Singapore banking. What are your thoughts on Singapore's banks? Are you buying, holding, or selling UOB or DBS? Let me know in the comments below. And if you got value from this deep dive, please hit that like button and subscribe to the channel for more analysis that goes beyond the headlines. Thanks for watching.